Now, good evening, everyone, and welcome to SPL Tutorials, your preferred online learning platform. My name is Samson Okari, and I'm glad to take us through Introduction to Financial Management class. Now, this is paper number 8, Financial Management. And the objective of this paper is to equip the candidates with knowledge, skills, and attitudes that will enable them to apply financial management principles in practice. The learning outcomes of this paper is that by the end of this paper, or a candidate who passes the paper number 8, financial management, should be able to, number 1, analyze the sources of finance for an organization and evaluate various financing options: debt capital, equity capital, preference capital, and many other forms of financing that an entity can have. Number 2, evaluate various investment decision scenarios available to an organization. Number 3, evaluate the performance of a firm using financial tools, and then make appropriate capital structure decisions for a firm, what you usually call the optimal or the optimum capital structure of a firm, and value financial assets and firms, make appropriate liquidity and dividend decisions for a firm, and evaluate current developments in business financing strategies. So those are the objectives that a learner, or the outcomes that a learner should expect in the financial management paper. Now let's start with the overview of financial management, and we will start with the first area, which is theoretical framework of financial management. Now, financial management can be defined as, or is concerned with, the activities of planning and running a firm's resources. The activity of planning and managing a firm's resources is what you call financial management. Now, financial management involves capital expenditure decisions. That means we're looking at investment in long-term projects, which is what we're calling capital expenditure decisions. Machinery, plant and equipment, and many other such decisions. Now, financial management is also concerned with how an entity acquires and utilizes resources so that it can be able to maximize the firm and the shareholders' value. We are going to look at later on the goals of a firm, and one of the goals of a firm is to maximize shareholder value. So you're going to look at how then can a firm be able to manage its resources by the way it acquires them and utilizes them in a manner that maximizes the firm value and also maximizes the shareholders' value. Now, what about the role and responsibilities of a finance manager? We are going to start with what are the functions of the finance management function. And a finance manager is a crucial function in any organization. And they play a number of roles, and they are charged with numerous responsibilities towards shareholders, employees, the society, government, and other stakeholders. Now, the finance functions can be classified into short-term and long-term decisions, that a finance manager will need to make short-term decisions, or decisions that will affect the entity within the next 12 months. And they also need to make long-term decisions. What are these? These are decisions that will affect the entity into the long term, beyond 12 months. For example, setting up a plant that will generate some cash flows 3 or 4 years from today. That's a long-term decision. Now, the long-term decisions involve projects or activities with a long-term time horizon that is more than a year. And such decisions would include investment decisions, what you call long-term asset mix decisions. In other words, what assets should we purchase or should we procure for the long-term aspect of the entity? We have financing decisions, which we also call capital mix decisions, which basically we are going to look at later on, but basically they relate to how much capital do we have in terms of debt, in terms of equity, in terms of preference share capital, and so forth. And what is the optimum capital mix? In other words, what proportion of equity capital should we have in our books, and what portion should be financed by equity share capital? We have dividend decision, which we also call profit allocation mix. If we have 1 million Kenya shillings as our profit for the year, how much should be retained? How much should be distributed in form of dividends? That's what we call the profit allocation mix, or we also call dividend decisions. Now, given that we have discussed that, we also look at short-term decisions, which involve projects or activities with a short-term time horizon. And such activities would be liquidity decisions. And this is to deal with short-term asset mix decisions. How much cash should you hold? Should we invest part of the cash in short-term investments to earn some revenue or some interest income? How much inventory should we have in the stores and other short-term asset mix decisions? Now, both the long-term and short-term financial management decisions require skillful planning and control in order to enhance the value of the firm and shareholders, which is why we need to discuss and talk more about the finance manager and their role, because it requires skillful planning and control in order to enhance the value of the firm and the shareholders' value as well. So now, friends, let's go ahead and now start discussing the role and responsibilities of a finance manager, in which case the first such a role is the financing decision. Also, we've called it the capital mix decision. Now, the first and important function performed by the finance manager is the financing decision or the capital mix decision. The finance manager must decide how the firm acquires financing to meet its investment needs. In other words, are we going to get some preference share capital, some debt capital, some equity capital, and many other capital sources that we need to obtain? What is the proportion of debt capital that we should have? What is the proportion of equity capital that we should have? What is the proportion of preference share capital that we should have in our share capital or the capital structure of the firm? Now, the most important decision in the financing decision is to determine the appropriate proportions of equity and debt capital in the company's capital structure. And the finance manager must aim at obtaining the best financing mix, which is what we call the optimum capital structure of the firm, so that we are not so much into debt and we are not internally so much financed by internal sources. In other words, we are not equity driven. Now, the capital structure of a firm is considered optimum when the firm's value is optimized. Now, use of debt capital in a firm affects both risk and return for the firm. That is, debt capital increases the returns of the firm because it gives the firm the ability to do projects which it would not have done if it relied only on its own sources of capital. But also, debt capital increases risk due to leverage or gearing. Because of the high gearing ratio, there's a risk. Now, what about equity capital? Use of equity capital decreases financial risk, but also it makes the firm to focus on organic or internal growth, which will limit the firm's investment activities. It indeed decreases financial risk because the suppliers of funds are the owners of the entity. But at the same time, it does not allow us to grow. It allows us to only grow organically or internally, because it will limit us. There are some investment opportunities that we might not explore because we do not have sufficient capital to explore such projects. So we need then to look at the best balance between debt capital and equity capital, which is what we are calling the optimal or the optimum capital structure of the firm. We shall look at the capital structure of the firm and what the optimum capital structure of the firm is in another topic. But this is just an introduction to financial management and the finance or the functions of the finance managers. Now, the second function of the investment manager or the finance manager is what you call investment decision, also called the capital budgeting decision. Now, what does this mean? This is the decision of allocating capital or commitment of funds to long-term assets which are expected to generate cash flows in the future. So we are allocating some funds to long-term assets in anticipation of them generating cash flows in the future. Again, capital budgeting will entail looking at how much resources do you have for long-term projects, and what are the projects that we have that we need to do, so that you can be able to prioritize on which projects we are going to take and which ones we have to drop because we do not have sufficient capital to pursue such projects. We shall look at capital budgeting as a topic later on in financial management. Now, capital budgeting is the process by which a firm selects which long-term investments to make that are consistent with the goals of the firm. In other words, we are going only to carry out or to undertake investment decisions or to undertake long-term investments that are consistent with the goals of the firm. That are consistent with the goals of the firm. Friends, the third role and responsibility of a finance manager is what we call the dividend decision. We also call it the profit allocation mix. And what does this relate to? It involves the decision of whether to distribute all of the profits as dividends, 100% distribution, retain all the profits, that is 100% retention ratio, or distribute a portion of the profit and retain the other for investment purposes. So we have to make such a decision. What proportion is going to be retained for pursuing opportunities that may present themselves to the firm, and how much are we going to distribute as dividends so that we can be able to encourage the shareholders that there is a return for their investment, and also we can be able to lure those potential investors that they can be able to invest with us their money, and we can be able to pay them lucrative dividends so that we don't lock them out by them looking at our financials and seeing that over the 10-year period, we have not issued any or distributed any dividends to our current shareholders. The fourth decision that finance manager must make is what we call the liquidity decision. And when we talk of liquidity decision, we are talking about the management of current assets and liabilities, short-term debts, and the investment of surplus funds. In other words, we are looking at how can we make sure that the entity is liquid? That is, it can be able to meet its obligations as and when they fall due. This can only be made so if we manage our current assets well. We should not have a lot of inventory, but we should also not have very little inventory. We must make sure that we have cash levels that can be able to help us to pay off our debts as and when they fall due. But again, we don't have to have a lot of cash at hand because of the risks it poses of theft, and also as well because we'd have had opportunities that we have foregone. The cash can be invested in short-term investments to earn us some income in form of interest income. We also need to manage our liabilities, the short-term liabilities. How much of bank overdraft can we take at a given time? How much of short-term debts can we have? And how can we invest the surplus of the funds that we have using various models that we shall look at later on when we shall look at cash management, like the Miller-Orr model, the Baumol model, for determining the cash levels that we should have, for example, so that the excess cash can be invested and earn some income for us. So friends, those are the 4 functions of a finance manager. We have looked at the financing decision or the financing function, which you have also called the capital mix decision. We have looked at investment decision, which you have also called capital budgeting decision. Number 3 was dividend decision, also referred to as the profit mix decision or the profit allocation mix decision. And the 4th was liquidity decision. Now, before we look at something else, let's now look at the factors to consider when accessing capital. What are the factors that as a finance manager you need to consider before you can access capital? The first one is the cost of capital. How much will it cost us to acquire that capital? Be it equity capital, be it some corporate bonds, be it some government bonds, be it are we issuing some preference share capital? Are we issuing debentures? How much is the cost of obtaining that capital? Number 2 is the legal requirements of accessing the capital. If it's preference capital, if it's equity capital, if it is debentures, if it's preference share capital and other sources of capital, what are the legal requirements for accessing such a type of capital in the economic environment in which we are operating? We also look at flexibility of the capital source. How flexible is the capital source? Can the lender allow us to restructure the loan, for example, in case we are in trouble, or it is a fixed amount that we can pay forever until the loan is exhausted? Then we have how the source of capital affects the control of the firm, how the source of capital affects control of the firm, which we can call also dilution effect. In other words, for example, when you issue more shares, it means dilution of control. It means new owners of the company are coming in, and decisions that we've been making before, we now need consultation to the new shareholders in order to make any such decisions. So we need to consider how the source of capital affects control of the firm. Now, friends, having discussed on the functions of a finance manager and the functions of financial management, it's now time for us to go ahead and look at the goals of a firm. What are the goals of a firm? Now, the first goal of a firm is what we call profit maximization. And when we talk of profit maximization, in economic theory, we are talking of the behavior of a firm, which is analyzed in terms of profit. Now, profit maximization implies that the firm either produces maximum output for a given amount of input or uses minimum input to produce a given output. In other words, can we be able to reduce our costs such that we are only using the minimum input to produce a given output? Can we use the minimum kgs of green tea to produce processed tea? Or how can we maximize the output from a given amount of input? That's what we call profit maximization. Now, it is assumed that profit maximization causes efficient allocation of resources under a competitive market environment. It causes efficient allocation of resources, that's an assumption, under a competitive market environment. Now, the second goal, before we go to the second goal, let's look at the weaknesses of profit maximization as a goal of a firm. And the first weakness is that it ignores other stakeholders of the firm. For example, the customers, the employees, the lenders, and the society at large. Number two is that there's uncertainty of the returns of the firm. The firm's returns might not be consistent. So there's uncertainty whether, for example, during the COVID-19 period, many firms that had anticipated to make profits made serious losses. So there's uncertainty of the returns of the firm. And then we have unclear definition of profits. In other words, what is profit? We have got another weakness that it does not take into account time value of money. The value of a shilling today is not going to be the value of that shilling tomorrow. Now, profit maximization goal does not take into account the time value of money by discounting the profit so that we can be able to get the correct position we are in terms of performance as a firm. Now, it also assumes that firms operate in a perfect competitive environment, which is not the case, where transaction cost is zero. It can never be that transaction cost is zero. So we are not operating in a perfect competitive environment, which are the profit maximization goal assumes. The second goal of a firm is what we call shareholder wealth maximization. Friends, this implies maximizing the net present value of an investment, thus, in effect, maximizing the wealth of the shareholders. Net present value refers to the difference between the present value of benefits and the present value of the costs of any investment project. In other words, the present value of the cash inflows that we have received, we less the present value of the cash outflows. The difference is what we call the net present value. You discount the cash outflows, you also discount the cash inflows. The difference between the present value of the cash inflows and the cash outflows is what we call the NPV, the net present value. We shall look at net present value later on in capital budgeting and discuss about it in detail. But then a financial action that has a positive net present value increases the wealth of shareholders and is therefore desirable. If we get that the difference between the present value of the cash inflows and the cash outflows is greater than zero, that means it's a positive net present value. Therefore, that implies it increases the wealth of the shareholders and should be desired. Now, on the other hand, a financial action that has a negative present value should be rejected since it erodes or destroys shareholders' wealth. It should be rejected, given that it destroys or erodes the shareholders' wealth. In other words, when making decisions whether to accept or reject a project using the net present value approach, any project that has its net present value less than 0, which means that the present value of cash outflows is greater than the present value of cash inflows, should be rejected. Now, the objective of shareholder wealth maximization, friends, is to take into consideration the time value of money and the risks in any given investment. So the objective of shareholder wealth maximization, as you can see, given that it's using the net present value of an investment, is to ensure that shareholder wealth is maximized by taking into consideration time value of money, which was not being taken care of by the profit maximization goal. Because we said one of the weaknesses of the profit maximization goal is that it does not take into consideration the time value of money. Now, in wealth maximization, the fundamental objective of a firm is to maximize the market value of the shares of the firm. The objective of that firm, the goal of that firm, is to maximize, which is a fundamental objective, maximize market value of the shares of the firm. Now, what are the criteria used in measuring shareholder wealth? What criteria are going to be used in measuring shareholder wealth? Because we have mentioned them already, but we can emphasize on them. Number one is the market value of the shares. Now, the market value of the shares of the company, if listed in a securities exchange, is what you're going to use to determine the shareholder wealth maximization maxim. For private companies, the market value of the shares can only be reflected when there is an impending merger or acquisition, because you cannot readily determine what the market value of a share of a private company is, unlike a listed company, which you can easily obtain the value of the share from the securities exchange latest transactions. We can also use the breakup or liquidation value in determining shareholder wealth maximization. And in this case, the basis is used only when the firm is facing a threat of liquidation, and therefore the management may have decided to sell off the individual assets to raise cash. So you're going to look at what's the breakup value or the liquidation value of the company. We can also use statement of financial position evaluation, whereby we perform it regularly, that's either annually or semi-annually, to look at the health of the statement of financial position in terms of, for example, how do the current assets look like? How do the liabilities look like? Current and non-current? What about the equity? What about the debt, and so forth? So we do statement of financial position evaluation or analysis, and this is performed regularly. It can be either annually or semi-annually. And those are the three criteria that can be used in shareholder wealth maximization analysis. Generally, friends, shareholders wealth maximization is considered the major goal. Generally, shareholders wealth maximization is considered the major goal of the firm and affects the financial decisions of a firm. In other words, of the goals of the firm that you're going to look at, we have already looked at profit maximization and we have looked at shareholder wealth maximization. We are saying that shareholder wealth maximization ranks ahead of any other goal because it's considered the major goal of the firm and affects the financial decisions of a firm. Because the shareholders' wealth is the one that should be maximized, be it in dividend decision making, be it in short-term and long-term decision making, we are going to focus on shareholder wealth maximization as the major goal, as the overriding goal in making any decisions that you're going to make for the firm. Now, the third goal is business ethics. The third goal of a firm is the business ethics. And friends, this goal focuses on the conduct of a firm in a given financial environment. It prescribes the acceptable behavior of a firm in the economic system. How should the firm conduct its affairs? Now, ethical considerations of the firm may include the following. Number one, fair competition prices or practices, fair competition practices, which include avoiding monopolistic tendencies. Number two, employee welfare. That is through competitive wages, competitive training, career development, and safe working environment, conducive and safe working environment. It can also be done through full disclosure of financial statements to shareholders and potential investors. And this would include avoiding window dressing and accounting manipulation. Also, we can talk about sustainable utilization of resources as one of the ethical considerations of a firm. Sustainable utilization of resources means we are utilizing resources, not depleting them, but in a way that is sustainable. For example, if you are a company that is using trees, we do logging of trees, we should be able to do it sustainably in a way that we are not doing deforestation, but you're doing cutting down the trees and doing some reforestation, doing afforestation in other areas, and also making sure that at least for the number of trees we are cutting down, we are replacing them. And it should not be that we are cutting all the trees at once and replacing them at the same time. So we need to be sustainably utilizing the resources at our disposal. We also have providing quality products to the customers. We should not focus on mainly profit maximization at the expense of providing quality products to the customers, such that we might find that we are producing goods or products that are of poor quality, that we are giving out sugar, for example, which has mercury, or we are giving out products that have not been checked by the Kenya Bureau of Standards to check that they are of the highest quality. We also need to avoid discrimination on the basis of gender, race, or marital status. That is business ethics considerations. Avoiding discrimination on the basis of gender, race, or marital status. The fourth goal of a firm, friends, is corporate social responsibility. We can also call it CSR, corporate social responsibility. And this entails, or a firm is required to focus on activities over and above its general operations in the economic or financial environment. We should not only focus on ourselves as a firm, but rather we are required to also look at other activities over and above the general operations of the financial environment in which we are in. Now, we should engage in philanthropic activities, or the firm should engage in philanthropic activities, such as providing donations for sponsoring social events, providing education scholarships to needy students, provision of water and other amenities to society, and using resources responsibly. However, some scholars would dispute with the corporate social responsibility goal by saying that the firm's existence is not to provide such things to the society, when it is the government's responsibility, for example, to provide education, to provide social amenities like water and others. But then others would also argue that there is what we call the social contract, that by us as a firm existing, we exist at the mercy of the society. It's the society's support that has made us where we are as a firm. And for that reason, we should give back to society by engaging in such philanthropic activities. For example, providing donations for sponsoring social events, providing education scholarships to needy students. And this has been really done very well by many banks. You can hear of KCB, Cooperative, you can hear of Equity, Wings to Fly. Many of these banks are really embracing the provision of education scholarships to needy students. So this is going a great way in helping needy students to further their career or education goals. So corporate social responsibility is another goal of the firm. And our friends, that should mark the end of our session for today. And in today's session, we have looked at what the objective of the paper number 8, financial management, is, what are the learning outcomes expected. We have looked at the theoretical framework of financial management in terms of what are the functions of financial management. And we've also looked at the goals, that we have looked at the roles of the finance manager, which were about 4 of them. We had financing decision, we had the investment decision or capital budgeting decision, we had the dividend decision or profit allocation mix, and we had the liquidity decision. And finally, we have looked at the goals of a firm. And in the goals of a firm, we have talked about profit maximization as one of the goals. We've talked about shareholder wealth maximization as the next goal, shareholder wealth maximization. We've also talked about corporate social responsibility as a goal, and business ethics. So business ethics was the third one. And finally, we've talked about corporate social responsibility. Thank you very much for tuning in. I hope you've enjoyed. Thank you very much.